there are some differences in these two proposals coming out, both called Tax Cuts and Jobs Bill. And you can see these differences, sort of a few of them here, but we really don't want to get lost in the trees and not see the forest. So we really need to understand that these are the same goals for both of them. So what we're going to do is do a little bit of context to understand where this is all coming from, and then sort of delve into the way in which these proposals are class-oriented, class-based, both along income lines, which has gotten a fair amount of play in the media, but also along the lines of wealth, that is, wealth used to make more wealth, or what we used to call capital, which has been somewhat less attention paid to it. And then it's also interesting to understand, these people who write these bills are not stupid. They've done some fairly sneaky smart things in terms of trying to sort of win certain groups over politically, and in terms of trying to attack certain other groups and states politically. So let's look at these first. So the first thing to remember, both of these bills, both versions of these bills, come out really of a 4-decade assault on equality in this country. Now we can hark back to our last Socialist president, David Eisenhower, when the top tax rate was 91% on income over $400,000. That would be roughly income over $3.6 million today. But things have changed. And most of you have probably seen a graph like this. Note that there was this period of time which we sometimes call welfare capitalism, sometimes called the golden age, in which while the 1%, the top 1% of households certainly got more than their share of income, still, they only ran around 10, 11, 12%. But something happened in the late 70s and early 80s, and that began to change dramatically. The other thing I want to note at that time period is that the corporate income tax at that time was about 30% of all federal government revenues. We find that something changed. You notice in the 30s and early 40s, the share of federal revenue coming from the personal income tax and the corporate income tax was pretty similar. But then, over the succeeding decades, the share of revenue of the federal government coming from corporate income taxes dropped dramatically. And in 2016, provided about 9% of total federal revenues. Personal income tax provided about 47%. Most of the rest came from Social Security, state taxes, excise taxes, much miscellaneous taxes. Here's the argument that is being made, and we have to counter it quickly and effectively. The advocates of these proposals say that there are two problems in this country in terms of taxation. One, the taxes are too high, and two, that corporations are profit constrained. They don't have enough money to invest. And that if we reduce taxes, several things will happen. So first they made a couple of empirical statements. Taxes are high, corporations don't have money to invest. Then there's this theory about what will happen if we change this. If we put more money in the hands of consumers, and this is where they spend a lot of time talking about middle-class households or middle-income households, those people will go out and spend it. That spending will encourage corporations, businesses to invest. Businesses will invest. They'll expand production. That means they'll have to hire new workers, and they'll create jobs. So the sort of picture here is what economists would call a virtuous cycle. It's sort of a demand-driven, trickle-down form of economics. But the idea is if we put more money in the hands of some people, both individuals and businesses, good things will happen. So let's see. There are empirical statements. Are taxes high? And are corporations profit constrained? So what I've done here is just taken a few countries around the world and said what proportion of government revenue is a portion of gross domestic product. That is, government revenue is a portion of everything that's produced in that country. And it's individual countries there, other wealthy countries like the US, but the other line to pay attention to is the line called OECD, Organization for Economic Cooperation and Development. It's the average of all these countries put together. So if you look back in the mid-1960s, the United States, which is the green line with those nice circles on it, and the OECD average were pretty similar. We looked a lot like other countries, other wealthy countries around the world. We were just slightly below, I think about 23% of federal revenue is about 23% of our GDP. The OECD average is about 24.5%. But then things diverged. And now the OECD average is up around 35%. We're still down around 25 or 26%. So we have diverged significantly from what's happening, what other wealthy countries around the world are doing. So it's hard to argue that we are overtaxed. Our corporations short of profits. This is corporate profits on a quarterly basis. And you'll see that they're doing pretty well, actually. Sort of tough time there in 2008 in the collapse. But even then, corporate profits didn't drop to as low as we were in 2000. So again, this calls into question the second claim that corporations are short of capital, they're profit constrained, they don't have money to invest. In fact, for those of you who pay attention to this, you probably know that a good portion of what corporations do with these profits is to buy their stock back. Good for corporate CEOs, because much CEO salary is tied to stock price, so if you drive the stock price up, you drive the CEO and other executive salary up as well. So it's a virtuous circle, at least for them. But it's hard to maintain that there's not enough money for investment. When we look at the income impact by class, we were interested in a couple of things. One, which groups get the largest cuts in terms of tax dollars? And two, which groups get the largest share of the total tax cut? This is comparing House and Senate bills. And the point here is not to remember the numbers, but to remember the points. So in the case of the House bill, I said, let's look at the bottom 20% of families. Roughly people whose family income is $25,000 or less, but they account for 20% of households in this country. Their average tax cut under the House bill would be about $60. Well, $60 you can't do much with. But the other point to note is that when you look at those 20% of the families are going to get a total of about 1.3% of all the tax cut that's coming on. It's really not a whole lot. Then we have a middle income quintile, about $840 average tax cut under the House bill. But if you're in the top 1%, things are a little more cheery. To be in the top 1%, last year your family income had to be over $730,000. And you would get an average about $37,440 tax cut. Year 1% would grab off 20.6% of the total tax cuts. That's sort of the House bill. The Senate bill is not dramatically different. The high category in the Senate bill are those even subset of the 1%, top 1%. Families whose income was over $1 million. There's only about 572,000 of those families. And they would get about 14% of the total tax cut. So this is really, this is sort of raw class power in terms of the impact income-wise. It's clearly, this is not only not only good for us, it's bad, and it's redistributive upwards. But it gets worse. What I gave you is the picture in the first year. There are some tricky aspects of both these bills. It means that over time, the upward redistribution effects are going to be worse. So by 2023, the middle quintile families who would get tax cuts, 89% would get them next year, but only 67% would still have a tax cut by 2023. And over 40% of households would be paying more in taxes by 2023. In the case of the Senate bill, as it came out of committee, by 2027, nobody whose income was less than $500,000 would have a tax cut. Everybody had more, pay more. Tax cuts proposed for business are proposed to be permanent. Tax cuts proposed for individuals are proposed to expire. That's the simplest way of understanding it. A couple other things going on. Tax brackets are going to be defined under the bills by something called the chain CPI. And the point of the chain CPI is it goes more slowly than the economy. So people will be gradually forced into higher and higher income brackets. In addition, while you read about the tax credits that are going to be put in the bill, for children, for example, those are going to be fixed. They're not going to change over time. In contrast, the personal exemption as it exists today is adjusted for inflation each year, so it gets bigger. So you might say, well, who are these bills really written for in terms of income? Well, there's a touching consideration here. In the past, you only got a child tax credit up to family income of $110,000. But Congress has believed that it was unfair to higher income families, so now income up to $1 million, you can still get a child tax credit. First, what they don't do, which is sometimes just as important as what they do do. Neither proposal addresses the fact that if you get your income in the form of capital gains, that is, I buy a house for $200,000 today and I sell it for $300,000 next year, I have a $100,000 capital gain. I buy stock at $10 today, 3 years from now I sell it at $20, I have a $10 per share capital gain. That's taxed much lower the wage and salary income, the highest tax rate, and these proposals do nothing to change this, the highest tax rate on capital gains is 20%. Dividends, General Motors pays me a dividend maybe because I own their shares. The highest tax rate of dividends are either 15 or 20% depending on the holding period. Those are both much lower than even modest and certainly higher income, higher tax rates on income and wage and salary. In both cases, the bills say that instead of just $5 billion you pass on tax-free, you can now pass $11.5 million on tax-free. And the House bill would eliminate this tax at all completely. I want you to think about this for a minute. We have a wealth tax in this country. We don't think of it that way, but it's called the property tax. So if you own a home, or even if you rent actually indirectly, you're paying that tax on a particular kind of wealth, a residence or building. But we don't have a wealth tax except for the estate tax on the huge chunks, the huge agglomerations of financial wealth. That was one of the things that Theodore Roosevelt wanted to address. He was convinced, I think correctly, that two things. The huge agglomerations of wealth have a bad impact politically. And secondly, he said, they don't even do a favor for the heirs, so the heirs don't have to do anything to earn it. They just get it because of a genetic lottery in terms of who they were born from, their parents. I think he was right then, he's right today. The other thing, the interesting thing that this does is say, let's get rid of alternative minimum tax, AMT. Now, to take a random example of what that means. In 2005, David K. Johnston got hold somehow of most of Trump's tax return in 2005. In that year, he reported income of about $150 million. He paid taxes at about $38.4 million. But if it had not been for the AMT, the alternative minimum tax, he would have paid only $7.1 million in taxes. So alternative minimum tax is designed, it's cumbersome, you could do it a lot better, but it's designed to make sure that high earners don't escape by paying ridiculously low tax rates. But even more important then is what's in terms of taxing in business income or income from capital. The first three kinds: capital gains. You buy something today, you sell it sometime in the future at a higher price, you have a capital gain. Dividends and interest. So these are all forms of income from capital, income from wealth. And this is where the bills really are designed, I think, to help out a certain group of the population. Now, there are two primary sources of this income from capital. One is what's called C corporations. You would recognize many of them: General Motors, Microsoft, Facebook, Intel, whatever. These are corporations that can have an unlimited number of shareholders. The shareholders can live both anywhere in the world. And for C corporations, the corporation itself pays taxes on the income. And if they pay out any of their profits in terms of dividends or interest, the people who receive that also pay taxes. The other source is and you may have seen this in the paper, what's called pass-through entities. Now, there are different kinds of pass-through entities. For our purposes, it's not worth worrying about the differences because they all share one thing in common. If you get your income from a pass-through entity, it literally comes from the source straight to you. The entity, whether it be an S corporation, a partnership, a limited liability company, doesn't pay any taxes. You can only have a maximum of 100 shareholders on an S corporation, for example, but there's a little loophole. You can count any family member, any number of family members through 6 generations as a single shareholder. Pretty neat, right? And you may be less familiar with pass-through entities, but probably have heard of the coal industries. The Trump organization itself is organized as a pass-through industry. And Jerry Jones is known as the owner of the Dallas Cowboys, actually owns it through something called the Dallas Cowboys Football Club, which is a pass-through entity. So in that case, those institutions don't pay taxes as an institution. If they pay out money that comes into them to the limited number of shareholders, those shareholders will be taxed today at their personal income tax rate. But here's what's going to happen. Sorry. So who gets this income? Well, not surprisingly, in terms of capital gains and dividends from C corporations, it's fairly concentrated. The top 1% of families by income in this country own about 1/3 of all stocks, whether in pension funds or directly or mutual funds or what have you. And they receive about half or so of the total income from dividends and capital gains. So fairly concentrated. And up until relatively recently, C corporations were the most important source of capital income. In 1980, they accounted for about 80% of all business income, or all capital income. But that's changed dramatically. Because an increasing portion of capital income from wealth, comes from passive entities. And the most striking thing about this is that income is even more concentrated than income from ownership of C corporations. About 70% of that income from passive entities goes to families in the top 1% by income. And now they account for about half or more of all business income for the first time. Trump himself has about 500 different passive entities. Both bills favor capital income over labor income. There are some differences in the treatment of passive entities. One bill, the House bill, says let's just tax them at the maximum level of 25%. The Senate says let's nothing, just take off a certain amount of their income and pay taxes on the rest. If you're a business owner, well, there's that made a difference to you. The rest of us doesn't make much difference. And both oppose to cut the corporate income tax rate from 35% to 20%. The House says right away. The Senate says in 1 year. Now, I know people have probably read that some large corporations pay less than 20%, and that's true. But there are a lot of businesses that do pay somewhere between 20 and 35%, so they will get favorable treatment here as well. And how important is income from capital and to whom? Here is again looking at that gain of income share of the top 1%, and it's plotted against the share of income the top 1% gets from capital. And that has been growing faster than the total share of income, and that's one of the drivers of increased inequality in this country. Income from capital, income from wealth, which is more concentrated than income from wages and salaries, and its concentration has been growing and increasing more rapidly. But this gets worse too. Let's imagine Sally Jones. Sally is CEO of XYZ company, and she gets paid the median CEO salary of 2016 of $11 million. But Sally's not happy because she has to pay on most of that income. She has to pay 38 or 39% in income tax under the current system. She doesn't like that. But under the new system, her lawyer says, Sally, we're going to restructure you into Jones Management Company. Services, JM, I should have said JM, yes. It'll be a pass-through entity. And Jones Management Services offers management services to XYZ in the person of Sally Jones. So now Sally gets her $11 million salary and pays a maximum of 25% of the House with this reduction in the Senate. So Sally's happy. She's cut her tax bill significantly this way. Now the drafters of these bills say, well, there'll be guardrails for people doing this kind of game. I have a lot of confidence in clever tax lawyers in this country. I believe they will figure out ways to get around it. This is a jobs creation proposal for tax lawyers. What it's down to, because it's a huge incentive to shift the way you get your money from wage and salary into a pass-through entity. So that will happen. And then finally, another thing that Congress has thought they should, these two drafters, the two bills thought they had to worry about, is what you might call stranded or orphaned capital. You know, those profits that are sitting overseas, by the way, most of them are not actually physically overseas, but $2 trillion plus overseas profits, that if they brought back would be subject today to the 35% corporate tax rate, or under the proposals to 20% corporate tax rate. The bills propose 10% and 12% as the tax rate on the money coming back. The single biggest beneficiary of that is why I consider the iconic neoliberal firm, Apple. Apple has about $240 billion of stranded capital overseas. It's about 94% of all the capital the company has. And I know a lot of people like Apple because it produces these fantastic gadgets, but this is not a company that has our well-being at heart in terms of how they operate. Wealth. We told them wealth would trickle down. You can look and figure out who is saying what there. We are living in a period that I refer to, many of you may refer to as neoliberal capitalism. And there's four features: decrease taxes, deregulate, destroy workers' voice, and privatization of education, healthcare, etc. So one way of getting at this in this tax bill is something I mentioned before, this either elimination of the deduction for property taxes, state and local income taxes. Both bills contain parts of it. And if you think about, find out who actually uses these deductions, it's actually, I said 20%, it's actually about 25% of filers use them, but they're very concentrated in certain states. California and New York, for example, are about 1/3 of those. And there's 6 states where the deduction for state and local income taxes is most heavily used by filers. California, Connecticut, Maryland, New Jersey, New York, and Oregon. All 6 of these voted for Clinton. These states all took the Medicaid expansion under ACA. They all have minimum wage levels considerably above the federal minimum wage. And they all have higher levels of unionization, particularly in the public sector than nationally. Trump promised to destroy what's called the Johnson Amendment. So the Johnson Amendment, named after Lyndon Baines Johnson, was passed in the 1950s, and what it does is prohibit nonprofits such as churches, universities, and charities from endorsing candidates for public office. The House bill proposed to repeal that amendment. What that has to do with taxes is not clear, but it has a lot to do in terms of appealing to a certain part of the base. The House bill would also make it more difficult for immigrant parents to get the tax credit for their children, if their children were born in the U.S. And the other thing the House bill does is something that is particularly insidious, I think. Buried in there is a phrase that says, a child in utero means a member of the species Homo sapiens at any stage of development was carried in the womb. So they've been trying to reach into, to codify in federal legislation the notion that unborn are people. It's buried in the House bill. It might be a basis for somebody arguing that abortion was murder. On to what we can or should do about it. I'll be quick here. So first, if you haven't done it, go to the notonepenny.org website, take the pledge, but more importantly, make sure your rep and your senator takes that pledge as well. It's a group, notonepenny.org, it's a coalition, the argument not 1 penny more, not 1 penny of tax cuts to higher income and wealthy people. Organized media is obviously with your congressional reps. Do phone banking. Not 1 penny is organizing phone bankings into legislative districts where you have Republicans. Because if we don't sway some Republican legislators in this, we're not going to win. We may keep 100% of the Senate vote for Democrats and probably close to 100% of the House. But that's not enough to win. We need to do more of that.